month of May, but we are still up about 5% for the year. And our next guest is fairly constructive on the Canadian market. John Goldsmith is head of Canadian equities at Montrusco Bolton and one of our regular guests. John, it's great to see you.
Thanks for having me, John.
Is the Fed decision, in your opinion, the biggest story to watch this week?
No, CPI.
Okay,
yeah.
Which are coming out the same day.
Yeah, exactly.
Is CPI in the morning, Fed decision in the afternoon?
I think it's pretty much fait accompli that the U.S. is not going to be, or the Fed will not be raising rates this coming meeting. And if you look at consensus estimates or WIRP on Bloomberg, the expectation is basically that there's likelihood for one increase or decrease, I should say, in Fed rates between now and end of year, but nothing coming up over the next couple of meetings. And also, you also bring in the how apolitical is the Fed meant to be? We know that there's this election south of the border in a couple of months' time.
That.
Yeah, so just in case, you know. Any decision to cut rates between now and November will probably be viewed as extremely political. But like you said, prior with regards to the U.S. jobs report, U.S. economy is humming in pretty good. Unemployment rate's good. Jobs are being created. So there doesn't appear to be some type of pressure, needing pressure to reduce rates right now in the U.S.
And given that we came into the year with this expectation we were going to see the Fed cut rates multiple times over the course of the year.
6 times.
So what do you think is the main driving? I mean, certainly, as you say, inflation could be a driving factor this week. But what do you think the general view of investors is if they've been willing to bid up stocks, even if the rate story has changed very dramatically?
U.S. economy is extremely resilient. Simple as that. You have GDP that is not sub 1%, and you have unemployment that is still, all else being told, at extremely low levels. Yeah, we saw slight upticks, but these upticks are really, very small in the grand scheme of things, and nothing highlighting the fact that the U.S. economy is running off the rails.
And by comparison, here in Canada, we just saw the first rate cut by our Bank of Canada in 4 years' time. What do you make of the Canadian economic picture, which, on the one hand, has benefited from some of that U.S. resilience, but there are some clear signs of a cooler economy here by comparison?
Yeah, so there's always a question of gauging what expectations are. The stock market typically moves on expectations, but then you have, what the reality is. And if we dial back the clock to the beginning of the year, you mentioned before 6 anticipated rate cuts in the U.S. We're now probably at best going to get 1. You'd expect with that type of narrative that the economy, not the economy, but the stock market would have taken that pretty negatively and would have been off. Instead, what we have is the reverse. We have the stock market in the U.S. probably at, if not higher, than where most economists and market strategists were expecting the S&P 5 to end the year at. So getting back to your question on the relative attractiveness of the Canada and the U.S., it looks like Canada is probably within the next couple of months or quarters, close to perhaps troughing. And at that point in time, the longer it takes for the U.S. to actually start cutting rates, i.e. to stimulate the economy, it actually puts Canada in an interesting position, Canada, Europe, what have you, to actually show an acceleration of growth at a time where the U.S. might weaken. I don't expect this to happen over the next 6 months, but this could be the narrative for next year.
The thing I've heard from a lot of pundits in recent months about Canada's stock market is that at the end of the day, even if we're seeing signs of, consumers feeling stretched, high household debt levels, all that kind of stuff, that we're more leveraged to the global economy and demand for things like commodities, and those are drivers for the Canadian stock market. So if you see a little bit of outperformance coming, what are the factors that would be driving that outperformance, the kinds of sectors in your opinion?
Hands down, in periods where the Canadian market outperforms the U.S., it's a function of, 1, U.S. dollar weakness, i.e. currencies outside the U.S. strengthening, and then secondly, obviously, because of commodities. So we know that the financials are a large weight. The banks are over 22% of the Canadian benchmark. But the key thing here is really to get that positive tailwind coming from whether it's energy side, so oil and natural gas, and we can talk ad nauseum on those two, or on the base materials and gold on the other side. And the base materials are obviously a very key part of the whole energy transition. If you believe in electric vehicles and renewables, you need lithium, you need copper, you need aluminum, you need cobalt, you need nickel. Guess what? Canada's got a lot of those. And that's where you could possibly see resurgence of interest for the Canadian stock market.
And in terms of individual stocks, like there are some energy names that you've been tracking quite closely, including Canadian Natural Resources, Tourmaline. What is it about the makeup of those businesses that kind of feed into this narrative you're talking about right now?
Yeah, so, basically something happened post-COVID, and specifically with regards to the energy companies, first and foremost, is that they basically a newfound religion with regards to capital allocation. So instead of just growing production for production's sake, they've really looked at enhancing shareholder returns by, one, focusing on free cash flow and free cash flow per share, two, reducing debt, three, increasing dividends and share buybacks. And these two companies, both in the case of the oil side, which would be CNQ, Canadian Natural Resources, as well as Tourmaline, which would be, the leader in Canada with regards to natural gas, are two premier ways to play the energy transition. One on the oil side, obviously we've got TMX pipelines that just came in. You're having heavy oil differentials fall. CNQ has pretty good exposure to that with regards to their oil sands projects. And then secondly, you have Tourmaline with Canada LNG coming on in the next couple of months. You're going to have basically close to 10% of Canadian natural gas production flowing off of the west coast of Canada. When Canada LNG 2 gets approved, that you've got basically a fifth of Canadian production going off. And Tourmaline is one of two Canadian companies that actually gets exposure to LNG prices, which are substantially higher than North American natural gas prices.
Always